You're listening to the Savings Tip Jar with Dom Beattie and Denise Raywood, brought to you by Savings.com.au, your home of savings news, guides, and product comparisons. G'day, how you doing? Thanks for joining us for another episode of the Savings Tip Jar, episode 154. I'm Dom Beattie, the editor of Savings.com.au, alongside our senior finance journo Denise Raywood to price in the week's main money matters, including inflation falling to 4.2% and whether that rules out any more cash rate rises this year. Plus, the surprise lift in the unemployment rate. Should we be concerned? Is this the start of AI taking our jobs? And finally, now that the dust has settled from the RBA's last rate hike, we take stock of what the deposit market looks like and what rates savers can expect to earn from savings accounts and term deposits. After that, we'll talk to REA Group senior economist Angus on how property prices and rents could realistically be impacted by the changes announced in the federal budget. Don't miss that chat. And as always, we'll each share some savings tips. Hi Denise, how's it going?
Yeah, good, Dom. A few things. The dust is settling a bit with all the financial movements we've had this month. So, we're starting to see a bit more clearly, I think, of implications. It was definitely worth having a good chat to our guest, which we had recorded earlier. A few things there about the property market. I think that's what everyone's sort of interested in now. What's all this going to mean? Interesting times.
Yeah, for sure. Now, it has felt like a bit of a quieter one, which I'm actually quite enjoying because after all the chaos of the previous weeks with the RBA rate rise and then the federal budget and then the budget reply stuff, now it's sort of a bit of peace and calm, and now we've got actually some time to digest it all and analyse. But yeah, let's, as we usually do, let's start off with some savings tips. What have you got for me this week?
Well, this one I've thought of just in the wake of things that actually did come out of the federal budget, and it's for people who are looking to save for their home deposit. This is an old scheme. It's called the First Home Super Saver Scheme, and it's provided by the federal government. And why I've thought of it is because it's a way where you can stash some money aside with a voluntary or a salary sacrifice contribution at about a 15% tax rate. And, for those that are looking to whack their, savings into an investment vehicle with the changes through the federal budget of, a 30% floor on capital gains after the 1st of July 2027, that can eat quite substantially into a home deposit. So the old-fashioned First Home Super Saver Scheme, and you can Google this and look it up and see how it entails. Basically, you can contribute up to $15,000 a year. And when you get to the magic $50,000 of contributed money, and that's not your employer's contributed money, that's your own money, you can withdraw that and put that towards a home deposit. But, I think the reason that this sort of, lost a bit of traction is $50,000 does not go too far in today's property market for a deposit. It probably works best if you're part of a couple and you can both do this in your respective super schemes, and a $100,000 deposit is probably gives you a lot more to play with in the property market. But basically, when you withdraw the $50,000 to put down as a deposit, you won't pay money on that as it's already being taxed. I think if there's, a way that you haven't paid tax already, even that's capped at 30%. So it's not a bad way. It's better than putting money in a savings account where you get taxed on your savings at your marginal tax rate. And so for those who are sort of wondering about how they can make the most of their money and get it towards, it's a good chance for first home buyers now that there's this little bit of a lull in the market. Definitely look up the First Home Super Saver Scheme. I think it may have got a little bit more cachet with, things that came out of the budget. And it's definitely one that's, pretty old-fashioned and boring, but I think works. So that's my tip for those, particularly those looking to save home deposits.
Yeah, nice one. There's another perk to that scheme that I feel like isn't discussed enough, and that's actually how much you can earn on the money that you deposit in there. It's not like it's not earning the same amount as your actual super fund. Its earnings are essentially what's called deemed.
Deemed, yes.
And it's deemed at something called the shortfall interest charge that the government has. It's basically a rate of earnings that they set. I think every quarter they update it. Just for the most recent quarter, that shortfall interest charge rate is 6.96% per annum. So that's that's a pretty good rate. I mean, that's a lot better than you'll find in a lot of, I don't think any savings accounts are offering rates that high.
No one's at 6% yet. So that's very good.
And no term deposits will be offering that kind of rate either. Perhaps you could earn more in in an investment vehicle, investing in shares and whatnot. But there's risk with that. And when you're playing with a huge, your first home deposit savings, that's money you don't want to be throwing all into stocks, given you're likely to access that money within the next year or two. So this is basically like a government guaranteed rate that you will earn on that money. It's 6.96%. Obviously, that rate can change quarter on quarter. The previous quarter, it was 6.65%. And then the quarter before that, 6.61. So not a whole lot of change. It obviously moves up with the cash rate and whatnot. But I think that's a real perk. You're basically guaranteed to earn that sort of money. So you could make some serious returns on that money, and then on top of all the tax concessions. The only thing that maybe is the primary thing that puts a lot of people off is probably a bit of the admin involved. There's probably some extra forms to fill out. Maybe you have to wait some time to access that money. Fill out some forms is to be processed by a couple of bureaucrats, and sometimes when you're ready to go and buy that house, you need that money quite quickly. But if you're willing to put up with that and you've got a bit of patience to fill out some forms, it could be really lucrative, and you can certainly make a lot more money. I can't say certainly. This isn't financial advice, but there's an opportunity to maximize your deposit via this scheme. So nice one, Denise. Always worth highlighting that one because it is often forgotten about. My savings tip. Often I see people talking about, when their kid is born, they want to set their child up and for in the future, and they want to set them up with a some sort of savings account that they can just regularly put money into for saving for their kid's future. I feel like if you've got a home loan, something you should seriously consider, rather than setting up a savings account, you should consider instead just keeping the funds for your child in your home loan's offset account or redraw facility. That's what we do. And that's because the interest rates on home loans are generally higher than the interest rates offered by savings accounts. And also, interest earned on savings accounts is often taxed, particularly if the savings account is in your name, it'll be taxed at your marginal rate. It's complicated when you're putting it in the kid's name. There's all sorts of things you need to worry about. There's also limits on the highest rate that the kid's account can earn. Often those are quite low. Might be only like 5,000 or so that you can earn the top rate. That's why I just think what you could do is keep the money instead in your offset account, and you can set up a spreadsheet to essentially keep track of how much their share of the offset is, and ensuring that you're being fair to the child, paying them a rate of interest that's equivalent to your home loan's interest rate. I understand there's a lot of people out there, the thought of a spreadsheet or creating one is very daunting and they don't know how to do it. These days with AI, you can just ask AI to create one for you. You just need to be specific about the things that how you want the account to work, how much you're paying the kids per week. Maybe we pay our kids it's just a $10 a week thing that goes into the spreadsheet. And then, what the interest rate is. So we just put whatever our home loan rate is. Although we're being a little bit extra generous, we just put like a flat rate of, it was a flat rate of 6%, even though our home loan rate was below that. Now our home loan rate has actually gone above that. So I'll need to just reminding myself I need to adjust the rate that they're earning. And then, factoring in things like inflation, that $10 a week that we're putting aside. That was when we first started. But then, obviously that $10 becomes less in value over time with inflation. So we ensure that $10 goes up 3% every year. So, maybe next year it's whatever 3%, whatever 3% is. Maybe it's like $10.50. My maths is probably off there. The next year. So these are all things you should take account of. But that's what I reckon. Just instead of opening a new savings account, keeping it all separate, you can just have the money within your offset account, but just keep track of what their share of the offset account is worth.
That's a good idea.
Cool. All right, let's get into the news, Denise, starting with the first one, which is actually just broken at the time of recording in the last hour, the inflation data that's just come out.
Yes, the Consumer Price Index figures came out today. We saw the headline rate of 4.2%, which was quite a bit lower than last month's 4.6%. A lot of this had to do with the federal government announcing those fuel excise reduction, and that saw effectively the price of petrol drop. So that's probably been a big contributor to that. And we saw headline inflation, and that's the underlying inflation in the economy. That's the measure that the RBA likes to look at when they make their decisions. And that decision, there'll be another RBA meeting, believe it or not, next month in June. And that one was actually had risen in the month. So 3.4%. That was a little bit higher than that was expected by the market as well. And to me, it suggests that inflation has sort of leached its way into the underlying economy. The RBA might have been trying to ring fence the inflation caused by the shock in the Middle East with that conflict there that, shot petrol prices up and oil prices, per barrel went a bit crazy for a while. But as we know, fuel prices have a way of flowing through to other sectors of the economy, and maybe a bit of that has escaped, and that may be what we're seeing there. So interesting times. And of course, you've got a bit to say about the unemployment rate, which also was a bit of a surprise last week.
Yes, yeah, but just touching again on just that inflation stuff, I think that, it came down a bit more than some economists had expected, coming down to 4.2% on that headline rate. The 3.4%, I think, was generally expected. That's the trimmed mean data. But yeah, I do think, I think just judging by the, how share markets have reacted, I think they're broadly quite happy with this, this data coming out, because it does imply that there's less chance of another rate hike. Certainly less chance of one in June, although there was already, the chances of that were already quite low. I mean, according to the ASX RBA rate odds, earlier this week, they were saying effectively there was no chance, there was 0% chance of there being a rate hike in June. That crept up to 4% yesterday. It hasn't reflected the latest data, the inflation data. So, but I imagine maybe that would creep back closer to 0%.
You'd think,
again. Yeah. I think that's pretty good news, but yeah, still, obviously, inflation is still a concern with trimmed mean at 3.4%, which is the more realistic figure these days. But certainly some scary numbers in that data release, with things like electricity costs up 22.5% on 12 months ago, but that's largely because those Commonwealth and state government rebates are no longer in place. So that's why we see the substantial increases. But obviously we know just generally electricity prices have been rising. Housing inflation still 6.3% over the past 12 months. That's still quite strong. The main reason for the fall in the headline rate was petrol prices not rising quite so high, and that coming down a bit through the data period by the ABS. But yeah, getting into the next story. So this again suggests that there'll be there's less chance of there being a rate hike, next month or even this year, or even at all this cycle. And that's the unemployment rate surprisingly picking up to 4.5% in April as more people entered the labour force, with demand skewed toward part-time roles. So this fresh data from the ABS last week revealed the number of employed people fell 19,000 while the number of unemployed people rose 33,000. And this was, I think most economists were expecting an increase in the number of employed people, not a decrease. So this was particularly shocking. Economists also expected the unemployment rate would hold at 4.3%, unchanged from March. But it's obviously picked up to 4.5%, which is higher than what a lot of the RBA's baseline assumptions have been. I think they were thinking, that the unemployment rate wouldn't really change much from 4.2 or 4.3%. So this was a bit of a shock. Of those who joined the market in April, 11,000 were looking for full-time work, and 22,000 job seekers were targeting part-time work. So, there's a bit of so some funny business, I think, because it coincided with Easter. I think that some economists have said Easter can be kind of a funny time for the job market. You can sort of see some influences there. There's Easter holidays, maybe there's casual employment or people coming into or out of casual employment. So, it can be quite volatile, the labour force figures from the ABS. So, we could see that fall back down to 4.4 or 4.3 in the next set of jobs data. But if it remains at 4.5% or continues to tick up higher, I think that's when the RBA will have some more serious concerns about that and actually starting to think, okay, maybe we will actually take further hikes off the table, because the RBA, of course, has a dual mandate these days. They've got to not just look at inflation, but also ensure that unemployment rate isn't getting away from us too, Denise. So anyway, we will, of course, be reporting on the next RBA moves. And the only other thing that I think that's worth noting this week, news-wise perhaps, is something that affects us all. And we did touch on it last week. Deposit market rates sort of back up there. Even this week, we're still seeing a lot of institutions coming through with what their new deposit rates are. Some have been a bit slower to act. Usually the smaller ones can be a bit slower. They're still passing through some of their rate rises from the last rate increase, let alone the May one. So, not every institution has passed on an increase this time, and that could be because they're happy enough with where their rates are at the moment. They've probably passed on 2 already this year, and they think their rates are competitive enough, and there can be market reasons for not passing that on as well. And that's the good thing. As consumers, we can vote with our feet or vote with our money and put it where the rates are the highest. It's some good rates out on the market at the moment. You can get, especially if you're a young person, some of these youth accounts have got, I think the highest youth accounts are 5.75% per annum interest rates, which is pretty good. There's usually conditions attached to those, and there's an age limit. I think Westpac life account is under 35. I think Newcastle Permanent also has a very good youth product that pays a good interest rate, and I think that's a lower age. So if you are in that lower age bracket, you can be earning really good interest at this time, and it's always good to have money at your pocket when you're younger. So get out there and check out and see what's around. For the rest of us that, are not that age anymore, you should be earning really well over a good 5% without having to tick too many boxes or meet too many bonus interest conditions. So if you're not earning that with your savings, it's really worth having a check and seeing where you can go to get it. It's not a hard thing to do. The government's tried all it can to make it very easy to transport savings between institutions, and your institution should help you do that without too much trouble. I've even heard reports that some of the bigger institutions who are losing deposit funds will sort of offer you a deal on the side before you move over. So, it's definitely worth doing the exercise and seeing what you can come up with. Yeah, certainly. Like looking at things like term deposits, you can get as high as, 5.7%? And that was with Rabobank's 5-year deposit. That's for amounts over $500,000. So
Yeah.
naturally, that's not too
Not for
many
everyone. Yeah.
of us. But yeah, there's certainly, if you've got like a modest amount of cash for shorter periods, you can get, there's 1 year rates around 5.45% to
Yep.
5.5%.
Yep.
With some of the smaller challenger banks, that's for deposit amounts as low as $1,000. So yeah, certainly it's not too difficult to get rates of over 5%. On your savings in either savings accounts or term deposits. But I think we've discussed this a bit in the office lately, and just wonder like how's that going to impact things like investments in like shares and stuff? Because yeah, I mean, when you can get almost like a guaranteed very low risk return of over 5% in a savings account or term deposit, why would you want to then invest in, say, even an index fund like a ASX 200? Given the ASX 200 over the past 12 months is what is it? It's only about 3.13% at the time of recording over the past 12 months. Yes, you can earn dividends on that, but I think the dividend yield on ASX 200 probably wouldn't be too much higher either. Maybe
No, I wouldn't think so.
Or 3% or so. So you're still kind of getting about the same level of return, but with obviously a lot more risk attached to.
And don't forget paying the 30% floor at the end when you want to sell off.
Yeah.
So
and then you've got these naturally these changes to capital gains tax coming in. There's not a whole lot of people, a whole lot of motivation for people, I imagine, at the moment to invest in stocks. Of course, investing in individual stocks, there's a real chance of I don't know, there's real chance, but certainly there's an opportunity to earn big returns but that's a lot more risk. You can obviously a lot more chance of losing all that money too. So it is interesting at the moment, sort of how much cash rate rises are impacting the state of investing habits at the moment.
Yeah, I think that's definitely a thing for the share market. The places that need public money to invest in them tend to be the startups and the newcomers. And, I guess that's what the government is discussing now with the business lobby and the tech lobby. There's not much of an incentive at the moment by the looks. So we'll see if there's any carve-outs that make that a little bit more tempting for just everyday mum and dads looking to where to put their cash. Because, the rules have changed a little bit, and people have got to sort of get used to the lie of the land. And, we'll see what happens next. And we don't really know. That legislation hasn't gone to Parliament yet. We'll keep you all informed.
Yeah, we'll do our best. But speaking of investing, obviously property investing is something that we're also working out. What are the ramifications of the federal budget on that? Also on top of obviously the higher cash rates. But we're going to discuss that just coming up right now with Angus Moore from REA Group. So that's coming right up. Okay, time for our dollar dialogue. And this week we're discussing the property market, in particular, how prices and rents could be impacted by the changes announced in the federal budget. And for that, we're joined by REA Group Senior Economist Angus Moore. G'day, Angus. Welcome to the Savings Tip Jar.
Thanks so much for having me. Great to be here.
Now, before we get into the property stuff, Angus, let us have your savings tip.
So, I'm an economist, so you should never listen to me for personal financial advice, but I am also very much a data guy. So it's going to be very much around that, which is just know what it is you're trying to save for, understand as much as you can about the data around that, and also the data around your income and your spending. There's so many tools out there to kind of get a sense of the trends in your spending, what you have and what you could save on. And so really that data is where my heart is, I suppose.
A true economist's answer being so heavily geared around the data. So I like that one, Angus. Certainly that's something. I'm a bit of a spreadsheet nerd myself. So I have lots of data spitting out stuff at me, percentage increases in this and this and that. But yeah, it really does help, particularly when you're tracking your wealth growth. Maybe not so much week to week because that can be a bit obsessive, but maybe, at least once a month or so can be really helpful. So yeah, getting into this topic here, you've obviously had 2 weeks to consider the changes announced in the federal budget. What do you see as the immediate outcome for the property market, or are we already seeing it?
Yeah, it's an interesting one. Obviously they're fairly meaningful changes. Certainly kind of the most interesting changes we've had to housing taxes in really a couple decades. The last time we saw changes to capital gains taxation was 1999. And you have to go back to the 80s to see changes in negative gearing. So the policies that we've had in place have been around for a very long time. And the reason I bring that up is it means that it's actually a bit hard for us to get a sense of what sort of effect to expect from this because we haven't seen changes in so long. And that's, as economists, that's kind of how we guess or, figure out what we expect policy changes to do is by looking at history. And fair to say, things have changed a lot since 1999 in Australia's housing market. That said, just because it's hard doesn't mean it's impossible. There is lots of modelling that's been done around these things. And the sort of expectation is that this will mean prices will be a bit lower. Not a huge effect. Treasury's modelling suggests about 2% for the next couple of years, slower growth. So, ending up sort of 4% lower than we might have otherwise been. There's a range of estimates in the literature. They're all in that sort of 1% to 5% range. So, meaningful, certainly there, but not a massive effect. Likewise, on rents, kind of in the other direction. We'd expect rents to be a bit higher, but again, not a huge effect.
Okay, I did see Westpac's latest housing forecast update yesterday afternoon, and they forecast a 34% drop in investor activity and a 20% drop in activity overall, and that sounds, quite amazing. Do you see it that way? Is that out of the ballpark?
Look, I won't comment on other people's forecasts. They've obviously put a lot of work into them and have their own views around things.
Come on, have a dig.
My expectation would be we'll probably won't see effects that large. Certainly over the longer term, one of the changes we will see is more owner occupiers, more first home buyers, and fewer investors. But again, the range of estimates in the literature are pretty small. And if you look at Treasury's numbers that they published in the budget, their expectation is for an extra 75,000 first home buyers over 10 years. So, 7,500 a year, which is meaningful. It's, it's a meaningful increase, but it's not huge in the scope of, the number of households, the number of homes in Australia, right? We're sort of talking, 11 to 12 million homes in Australia versus, 75,000 over 10 years. It's a relatively small number. I think in the near term, there's certainly a chance that we see a bigger effect than these sorts of, kind of structural estimates are, for the simple reason that people are still digesting these changes. They're trying to understand what they are. And so in that environment of uncertainty, we might see some effects over and above what, that sort of modelling would suggest. But over the longer term, I think these are fairly modest changes to home ownership, to home prices, to rents.
Now, Angus, you've sort of touched on what my next question is going to be, and that's around that core issue of supply, which I think is fundamental to this, total housing affordability crisis, and perhaps not so much all about the investor demand that's driving up the prices. I think it's really just we don't have enough homes being built to meet the demand. So, yeah, at the end of the day, do these changes address that core issue of supply? Is it going to mean that more new homes are going to be built?
Yeah, I think you've kind of hit the nail on the head there, Dom. When we think about housing affordability in Australia, it really does come back to building enough homes for the number of people looking to buy and looking to rent. Exactly what that number is kind of impossible to say because, people change how they live in response to how available housing is. You choose to live with more housemates if rents are really expensive or fewer if they're more affordable. But I think we can say with, quite a lot of confidence that we're not building enough at the moment. And the reason for that is housing affordability is around the worst level we've seen in, at least 3 decades. Rental affordability is at the worst level we've seen in at least a decade and a half, which is as far back as our records go. So clearly there's a lot to be done here. The budget had some measures around supply. There was a couple billion set aside for infrastructure, and that's tied to state and local government reforms and incentives. But I think it's fair to say there's more that we could do here. The difficulty for the federal government and the federal budget is that supply is mostly a local and to some extent state government issue. So it is a bit hard for the federal government to directly intervene there. But that's not to say there's not things that the federal government can't be doing. Things like tying funding to incentives for building homes, as well as coordinating reforms around planning, building, and things like stamp duty, which lock up homes for longer than they need to.
I think that the state governments and the territory governments will be, seeing a bit of a shortfall of funds as far as stamp duty goes. What do you see the flow-on effects of that being? I mean, they've made a lot of good, easy money out of it for a long time.
Yeah, stamp duty is a enormous source of revenue for state governments. It's always worth kind of stepping back and thinking about just how reliant we are, because we're actually really unique as a country in terms of just how reliant our governments are on stamp duty relative to elsewhere in the world. We're not the highest in the world. There are a couple countries that are higher, but we're right up there. And that's particularly true in states like Victoria that don't have mining revenues to kind of supplement state government revenue. I think the sort of broader point to make here is not necessarily, what effects these reforms will have on stamp duty revenue, which, there potentially effects there, and certainly the treasuries are thinking about it, but more that it points to just how volatile and risky, in a sense, a source of revenue this is for a state government, because it can swing by a lot depending on what's happening in housing market conditions. That makes it hard to budget as a state government, particularly when it's such an enormous source of the revenue. And so reforms that help move us towards more stable, more predictable, and better, more efficient sources of taxation, think, broad-based land tax instead of stamp duty, would help in a lot of ways, and this would be one of them.
Yeah, Angus, your forecasted sort of changes to property price growth and rent growth sound relatively modest given the scope of the changes that are quite substantial that are being announced. But why is that? Is that because the sudden drop in investor demand will be just cancelled out by a drop in listings, essentially keeping prices steady?
So there's kind of a few things going on in terms of the dynamics here. Part of the story is that those investors are replaced by first home buyers. So we see that demand come back. It's not one for one, which is why we expect prices to be a bit lower over the longer term. But it does, it means there's not that big pull away that we might otherwise see. The other fact that's going on here is, these changes, while they're, big changes, they are, serious changes to what have been long-running policies. They're actually relatively gradual over time. So the change to capital gains taxation, which comes in from 1 July, will move to inflation indexing, which is not necessarily massively different from the 50% discount. In fact, it's kind of worth stepping back and thinking about the 50% discount. In part, that was introduced in 1999, replacing inflation indexing. We're going back to the system we used to have as a simpler way to account for inflation. If you think inflation's roughly half of the return that you get, which, in the 1990s was not a terrible guess, then just dividing by 2 gets you roughly inflation indexing. And back in 1999, when everyone was filing on paper, calculating inflation was meaningfully administratively burdensome. It's not really true today when everyone files digitally, that can be filled in for you. And so it's that sort of administrative argument just isn't there. It's also worth noting that actually some people would pay less tax under inflation indexing than they will under the existing 50% discount. If you held a home in Melbourne from, say, 2022 to today, inflation has been more than half of the return on that home. And so you'd actually pay less tax under the current system. This is sort of a very long-winded answer to say that, this change does make it a bit less attractive. People will on average pay a bit more tax, but it's not a huge change. And so we wouldn't expect it to have a huge effect. Negative gearing is more of a change, but existing homes are grandfathered in. So that's going to be a very gradual transition. And newly built homes are exempt, which is a meaningful share of investor demand as well. And we'd expect more investor demand to flow in. So all of that sort of tempers how big an effect we'd expect to see.
Right. I'm just interested, is property investing still the go? Is it still a way to get ahead, and is it still a thing? What's your thoughts?
Yeah, I mean, look, I never give financial advice because I'm an economist, not a finance guy. But I think it changes the incentives for some people. It will change the calculus for some people, but I don't think it does for everyone. It really depends on what it is you're trying to achieve, what your personal financial circumstances are, what your tax arrangements look like. So it's really very much a personal decision. We would expect at the margin, we'll see a bit less property investment as a result of these changes. That's what's flowing through in the modelling. That's why we see slightly lower home prices, slightly higher home ownership. But it probably isn't a huge change, particularly as that carve out for newly built homes. We'll see some of that demand, converted into demand for off the plan and newly built.
Yeah, good answer. I mean, I personally feel that there probably is still money to be made from property investing because, fundamentally it is still a pretty attractive asset to hold, with the historically speaking, the steady gains, they're less volatile than shares, easy to leverage out of it. So, I think there probably has been a bit of a hysteria and overreaction to some of these changes, but I think people are going to slowly realize that, there's still plenty of money to be made from property investing. Angus Moore, really appreciate your time on the Savings Tip Jar. Thank you so much for your insights.
No, pleasure. Thanks so much for having me.
Thanks, Angus.
Thanks.
That was REA Group's senior economist Angus Moore, and that wraps up another episode of the Savings Tip Jar podcast. Now, if you really enjoyed this episode, you'd be doing us a massive favor if you could go to our page on Spotify or Apple or whichever podcast platform you listen to and give us a big 5-star review. That would go a long way to helping us reach more people, and of course all the other stuff, like review, subscribe, and check out Savings.com.au across social media, so Facebook, Twitter, Instagram, TikTok, and on YouTube. And of course, thanks very much to our sponsors. Thanks to our guest Angus Moore. Thanks to my co-host Denise, and thank you for listening. Catch you next time. Goodbye.